Okay, everyone, thanks for joining us. It's worth noting before we start that this is an excerpted briefing from our deep dive teardown on WeWork, which can be found on the CB Insights portal. This briefing will be shorter in length and the content covered, and we're definitely relying on the teardown as a research resource and as a backstop for this briefing. For those who are interested in learning more about WeWork, its competitors, and further detail on the topics discussed today, we recommend reading the teardown on the CB Insights platform. So before beginning, it's helpful to take a step back and grasp what WeWork looks like and where we think it's headed. With over $4 billion in funding, WeWork is expanding aggressively at home and abroad around the world and pursuing diverse investments that have raised eyebrows to some analysts. But it's real estate as a service offering powered by We, and a trove of data on optimal office design could make the company's value proposition far more than a marketing ploy. Our briefing will be divided into three main components. First, we'll start with the background on the company, looking at its leadership, its fundraising history, its investor composition, and recent news around its bond raising. Secondly, we'll look at the company's growth and expansion in the U.S. and abroad, as well as take a look at the acquisitions and investments it's made to date. Lastly, we'll dig into some of the technology WeWork incorporates in its leasing, design, and construction processes, as well as what that means for its enterprise offering powered by We. So we'll start here with the company's background. We put together a blueprint of the company's top ranks, its top executives, and while WeWork's leadership structure is fuzzy, these are the executives who either directly report to CEO Adam Neumann or have his ear. Since opening the first WeWork location in New York in 2010, the co-founders Adam Neumann and Miguel McKelvey have grown the company into a national and global brand. The company's corporate marketing centers strongly on an ethos of entrepreneurialism, and slogans cover the walls of rented WeWork office spaces, urging workers to do what they love and create their life's work. The company's executives position WeWork not just as an office provider, but a community. And WeWork has really grown its community and its membership base through a combination of amenities, partnership agreements, and of course, office design. WeWork has provided a really compelling starter kit to entrepreneurs and small companies seeking a place to work. As of March 1, 2018, WeWork reported 220,000 members compared to 130,000 members in May of 2017. This represents roughly 69% membership growth in 10 months. But underneath this aspirational culture is a fundamental business truth, and that's that the company makes money primarily through rent arbitrage, so it charges its members more than it has to pay its landlords. The principal means of accomplishing this is by packing a lot of people into all of its locations, and WeWork is quite adept at finding space efficiency. So in WeWork's buildings, the average square footage per person hovers around 50 square feet, and this compares to 250 square feet for commercial offices industry-wide. Despite this small footprint, members pay an average of $6,928 per year, with WeWork capturing a healthy 30 to 40% margin, according to the company. So WeWork has touted frequent engagement with other co-working colleagues as really a benefit of this creative community, and less a reality of just how crowded its workplaces are. So since its founding, WeWork has raised a mountain of money in the private market. Total capital raised to date includes $4.6 billion to its WeWork U.S. entity, with another $1.4 billion spread between its Asia entities formed in partnership with SoftBank. In February of 2014, the company raised a $57 million Series C and reached a $1.6 billion unicorn valuation in the private markets. Since then, each successive round has added billions to its valuation, which, following the SoftBank group rounds, has most recently ballooned to about $20 billion, roughly 20 times the company's reported 2017 revenues. WeWork's investor cohort weighs disproportionately towards larger institutional money managers like mutual funds, endowments, and banks, including the Harvard Management Company, JP Morgan Chase, Goldman Sachs, Fidelity, as well as traditional venture firms like Benchmark. But the company is also backed by some notable Chinese investors, including Legend Holdings and parent company to a parent company to Lenovo, Jinjiang International, which has ties to the Chinese government. But WeWork's most influential investor is definitely the SoftBank Group. In 2017, SoftBank closed its $93 billion vision fund aimed at buying significant equity in market-leading technology companies. And WeWork was one of the vision fund's first investments. The terms of SoftBank's deal were reportedly sketched out in the back of Masayoshi Son's car after a 15-minute visit to WeWork's offices. And commenting on the deal, Masayoshi reportedly urged Newman to make the company 10 times bigger, largely criticizing the organic growth it had seen to date. Based on WeWork's recent geographic expansion around the globe, it seems Newman and his team are putting SoftBank's money to use and taking his advice to heart. Despite these big equity raises, though, WeWork has splashed into the news again recently, raising debt in the bond markets. The debt raise has given the public a view into the company's internal finances. We're not going to address WeWork's financial health here, as this briefing is really only meant to investigate the company's corporate strategy. However, poor reporting of the bond raise, there are some facts that we feel are worth mentioning. So as part of the bond raise, WeWork has agreed to issue $702 million in senior notes that are due in 2025. Following the raise, in addition to further commitments from SoftBank, the company will have $3 billion of cash and cash commitments on a pro forma basis. So this really begs the question, why bring on debt? According to Bloomberg, WeWork reportedly has 14 million square feet in its real estate portfolio. And this is roughly equivalent, apparently, to the entire office and retail space in Canary Wharf in London. And this space houses around 250,000 desks. So the company has a high rent bill for all that space, with reportedly $5 billion in rent due by 2020 and $13.2 billion in rent due from 2023 onwards. So in light of its steep rent bills in the future, WeWork is taking action to mitigate some of this risk. WeWork is targeting more enterprise clients for its office space and expanding into third-party office management via its Powered by We solution. To date, 25% of WeWork's clients are enterprises, with some locating in WeWork buildings and other locating in real estate tailor-made by WeWork's construction, design, and Powered by We management tools. WeWork is also shifting from leases to co-management deals. So in this scenario, landlords might pay for the renovation and build out of offices and or split membership profits 50-50, similar to management agreements that have become quite popular in the hotel industry. So Newman says WeWork has followed this strategy nearly 100% of the time in markets like India and Israel. WeWork has also begun purchasing properties. So the company formed a real estate investment fund called WeWork Property Advisors in partnership with the Roan Group, and the fund was reportedly used to purchase the former Lord & Taylor building in New York City for $850 million. Lastly, WeWork is moving towards longer lease terms for its members. So WeWork has structured the incentives of its broker referral program to reward brokers who place members for a year or more instead of a month-to-month basis, according to the information. It's worth pointing out that according to research conducted by Emergent Research, the co-working industry is also changing in a similar fashion to the way WeWork is moving. So it's moving away from individual entrepreneurs and towards small businesses and companies employing fewer than 100 people. So next we'll take a look at how WeWork is growing and expanding. So with a huge funding jump from SoftBank last year, WeWork has been able to significantly scale up its square footage, which in turn has provided more capacity for membership growth. WeWork reportedly adds between 500,000 to 1 million square feet of new space every month. So the company is quickly expanding in the United States and abroad. As of February, it had 295 locations and counting. To date, WeWork has focused on the United States with 154 US-based locations, which is just over 50% of its global total. Within the United States, the WeWork offices are largely concentrated within New York City, which is home to 49 of the 154 US offices. Second to New York City, San Francisco and Los Angeles have 15 locations apiece, and Washington, D.C. is third with 10. So we analyzed the cost of membership throughout the US to see how prices stack up in each city. Based on the citywide average of WeWork's starting membership fees for a hot desk or an unassigned seat somewhere within a common area, as well as starting prices for a private office at a WeWork location. New York City and San Francisco lead as the most expensive in the United States, while Austin, Boston, and Chicago round out the top 5. It's notable that while LA is tied for second in its number of US WeWork locations, it ranks 6th for average starting price of membership. Outside of the United States, London has the second most WeWork locations after New York City. So while the average starting cost of membership is London is actually 20% higher than New York City. WeWork has certainly made London a central strategic focus, and according to the Financial Times, WeWork has become one of the largest office space tenants in central London, second only to the government offices of the United Kingdom. Beyond London and the United States, WeWork is also expanding in emerging markets with burgeoning tech scenes. This is true especially in China and India. We took a look at average prices in cities in these countries to see how they compare to other markets. China's countrywide average of $757 for private desk aligns with major U.S. cities like Chicago or Los Angeles. But when you remove Hong Kong, with a citywide average of $975 for private office and $455 for a hot desk, averages in locations like Beijing and Shanghai fall significantly, dropping down to $648 for a private office and $341 for a hot desk. Compared to China, though, India has significantly lower membership fees, with a $398 countrywide average for a private office and $180 for a hot desk. In August of 2017, WeWork purchased the co-working startup SpaceMob to boost its expansion outside of India and China, but throughout Southeast Asia. And the Singapore-based company will definitely lend a hand in expanding there. WeWork's acquisition of Naked Hub in April, I think, should be viewed through the same lens as the SpaceMob acquisition, and definitely can be seen as a play to expand further into China. The purchase of Naked Mob was reportedly for $400 million, that was mostly made in equity, and Naked Mob has 10,000 members and existing plans for 30 more locations within the country of China. It has 200 employees and will be joining WeWork's 250 employees in China. So, armed with all this capital it's raised from SoftBank and others, WeWork is not only rapidly expanding across the world, but it's also acquiring or investing in a bid to diversify its brand. So the company has added amenities and service offerings to its core customers, individual entrepreneurs and larger companies alike, via M&A and partnership. And WeWork's CFO, Artie Minson, described WeWork's investment scope as including companies that make WeWork stronger or can make our member companies stronger, according to the Wall Street Journal. So WeWork is definitely acquiring and investing in a good deal of companies. We've mapped them here for you. But it's also developing new types of WeWork brands. Its previous foray in this area is including its dormitory housing, We Live, but it's also expanding into fitness facilities called Rise by We, and even has plans for a private elementary school called We Grow. Some of these projects are definitely more promising than others. So we'll end by taking a look at the technology WeWork uses in leasing, design, and construction for its enterprise offerings. Aaron Fritsch, WeWork's head of product systems, has said that the single biggest blocker to WeWork's ability to expand is plainly and simply how many leases it can sign. So given the importance of fast-paced global expansion to WeWork, WeWork has a fairly calculated way, reportedly, of scouting its locations for buildings. So in a partnership with Factual, a location data provider, WeWork rates its locations based on proximity to amenities and businesses, including coffee shops, retail shopping, restaurants, bars, hotels, and gyms. And Factual claims that through this partnership, WeWork has driven a 95% increase in WeWork locations over a 12-month period between 2016 and 2017. What's interesting here is that proximity to other WeWork offices is also a large factor. So in cities where there are numerous WeWork locations, each additional location serves to drive down membership churn. Artie Minson, again, WeWork CFO, has noted that in cities where WeWork opened more locations, membership cancellations actually declined. So David Fano, WeWork's Chief Product Officer, has said that WeWork is in a unique position as one of the only true end-to-end solutions that is involved in every phase of a building's life cycle. That's from identifying, leasing, as well as designing, building, and managing a building. And the company leverages this advantage by measuring the usage of its offices. So each new location is informed by data from prior offices. So the company really measures the uses of its office space, and then on an ongoing basis in the construction of future offices, uses that data to design future offices. Once WeWork signs a lease and begins building out its office, technology really takes an even bigger role balancing both revenue potential as well as future office culture and community. WeWork's acquisitions of the architecture technology firm Case Inc. and of construction management platform FieldLens have reportedly been essential to improving the design and build-out phase conducted by WeWork's physical products team. So one of the first things WeWork does after signing a lease is 3D scan and map a space. The process, which reportedly takes an hour per floor, lets the physical products team capture square footage, window mullions, door sizing, really minute details. And WeWork's team specializes in building information modeling, in which after these buildings are scanned, they're planned in 3 dimensions and provide insight into the time and cost of construction. So WeWork has floor plan recipes and test these different layouts and office sizing using the information from their existing locations to predict where members will gather in a new location, how many phones should be installed, where to allocate resources, etc. So David Fano, again, WeWork's Chief Growth Officer, puts great emphasis on design and technology as it relates to WeWork's bottom line. He says that these old buildings, maybe an old building in New York or London, might have drawings, but they might be off by a foot or two. And if that happens, a desk they put in a new office might not fit, and that changes their fundamental business projections, their revenue projections. So one of the ways WeWork achieves maximum efficiency in planning their floor plans is through the use of machine learning. So to decide how many meeting rooms to construct, researchers at WeWork created a neural net that collects information on its existing buildings, layouts, and meeting room usage. And based on knowledge of its building layouts and meeting room utilization, the company can predict meeting room usage for a layout that is yet to be constructed. So in a test of the neural net system, the program estimated room usage 40% more accurately than WeWork's human designers did. The graphs here show that the number of hours a meeting room was utilized versus its predicted hours, with the neural net achieving far more linear correlation. The end result is a floor plan that you can observe just at face value that is packed quite tightly with private offices, meeting rooms, single-person rooms, open desks, and common areas. The more buildings WeWork opens, the more data it collects and the more its process improves. And this would seem to provide a strategic advantage other co-working startups and incumbents. The efficiency has reportedly paid off. According to its bond offering documents released recently, WeWork's construction costs per desk declined by 22% in 2017, falling to $5,631 per desk. I think what's notable here is also that this space efficiency is particularly appealing to corporates. So corporations across the globe are searching for ways to lower their square footage to cut costs generally, and WeWork's building design team knows how to maximize square footage and amenities so that employees don't feel crammed. So from a cost savings perspective, per The Atlantic, WeWork estimates it can save its enterprise clients anywhere between 25 and 50% in operating expenses. So WeWork has really applied this design and measurement efficiency to its corporate clients, developing a powered by We enterprise solution. WeWork designs its own spaces for enterprise clients and redesigns enterprises' existing office space. So corporations that use the Powered by We solution are offered WeWork office management software to help them book conference rooms, host guests, etc. And a community manager also sits within this space to assist as needed. Fast Company reports that WeWork's enterprise solutions are designed for companies with at least 1,000 employees, taking up 50,000 to 60,000 square feet. WeWork's ability to measure space is also a big selling point to corporates. So through the use of sensors and other measurement tools, WeWork can track how its office space is used, down to data as granular as what parts of the office see the highest foot traffic. Doug Chambers, who is head of the Powered by We program, told Wired that clients want to know how their space is being utilized, how they cut down on that space in places where it's not being utilized efficiently, and at the same time get that cultural community aspect happening inside of their buildings. So here are a few of WeWork's existing corporate clients. According to their bond filing documents, WeWork has signed up to 22% of the Fortune 500. And per Standard & Poor's analysis, WeWork expects large corporations to account for roughly 50% of WeWork's desks in just 2 years. This is increasing from 25% at present. Plenty of real estate players are taking notice of the shift to co-working, and WeWork's focus on corporate clients. Landlords are building out their amenities to compete with the likes of WeWork, as major commercial landlords are aggressively constructing communal spaces, happy hours, game rooms, and more to make their buildings more attractive to corporate tenants. We have this quote here from Lisa Picard of Equity Office saying that the way towers were built in the 1980s, they were really a monument to the corporation, but now, if anything feels corporate, that's really the kiss of death. So, major real estate incumbents are also angling to make competing investments in WeWork competitors. In January of 2018, Brookfield Asset Management and Onyx Corp, which is one of Canada's largest asset managers and private equity firms, bid on IWG, a flexible office space provider, for $3.7 billion. That bid was rejected. But IWG's co-working sub-brand Spaces has 39 locations in the U.S. that are either open to or set to open in the spring of 2018. Moreover, it plans on expanding the Spaces brand to 25% of its locations worldwide. The Blackstone Group has also made its foray into the co-working industry, purchasing a majority stake in the Office Group, a flexible office space provider, at a valuation of roughly $695 million. Blackstone is the largest landlord in the United States and one of the largest landlords in the world, and Blackstone also happens to be a landlord to WeWork. Some competitors have decided that it's better to work with WeWork than against it. So major real estate developers like the Rudin Management Company and Boston Properties have bought in on WeWork's value add to the building. Dock 72 opening in Brooklyn is an example of that collaboration. So we'll end here with some concluding thoughts. I think there are a couple major takeaways from our briefing. The first is that WeWork has proven it can quickly expand at scale, opening between 500,000 and 1 million square feet per month. And it's proven that it can design spatially efficient offices in non-identical locations. I think the second conclusion is that WeWork's enterprise business is vital to its long-term strategy. So if the company continues to add enterprise deals that cater to large corporates, we think it has a shot at living up to its sky-high valuation. Third, and obviously most topical to its recent bond raising, WeWork's accounting risk is very high. But it appears that the company's short-term risk of default on its lease obligations seems low, but really only given the strength of its balance sheet and deep-pocketed investors. Driving that risk down will likely require WeWork to limit the number of new locations that are leased, as opposed to co-managed or owned. And lastly, if WeWork can continue to improve on its efficiencies in office design and construction, the company could have a meaningful effect on commercial real estate more broadly. So now we'll take this opportunity to field a couple questions that folks might have after listening to the presentation. One question we're seeing is what competitors could take market share from WeWork. So we actually dig into this a little bit in the strategy teardown, which you could see on CB Insights. But I think there are some companies that have seen some recent momentum in co-working. Industrious is an example of a company that received a big Series C recently. Similarly, Notel is another one that has been in the news frequently. And as referred to, IWG Spaces, the sub-brand, is also making a big push to expand. So I think those would be examples of companies that are seeing some recent momentum. Got another question around the bond offering related to the community adjusted EBITDA metric. So, not to sort of dig into the minutiae there of their offering, but I think a lot of reporting focused on that community adjusted EBITDA. And I think, in 2017, the company reportedly had around $860 million in revenue. They had $930 million in losses. And they had this somewhat controversial metric of showing that earnings were $233 million in community adjusted EBITDA when you stripped out interest, taxes, depreciation, amortization, but also expenses like marketing, G&A, and development and design costs. The metric, I think, from reading, does include costs associated with running their existing facilities. I think one thing we read as a team is that Dan Primack of Axios covered this, and apparently he had a phone call with Artie Minson, and that the conclusion he came to is that it's really a measurement that is representative of the underlying economics of their business. So in other words, I think it goes to show that if WeWork stopped its aggressive expansion and flipped primarily to harvesting rent from its existing portfolio locations, it would show positive cash flow. Additionally, I think we saw in the Wall Street Journal that Fitch Ratings noted in its analysis that despite WeWork not currently being profitable, that it does have, quote, sufficient financial flexibility to substantially reduce growth and capital expenditures and operating expenses. So I think really the metric is meant to show what the company's profitability would look like should it switch to a profit mode. So that's it for questions right now. Thank you all for joining. Again, the full teardown is available on cbinsights.com, and we definitely refer you there for more detail. Thanks.